Crypto liquidity providing explained, earn fees like an exchange. In the world of crypto, most people know how to trade tokens or stake coins for passive income. But there's a lesser known way to earn like an exchange itself, by becoming a liquidity provider. And in this video, we're going to explain exactly how that works. From the basics to the risks and rewards, and how to start as a beginner. If you've ever used a decentralized exchange like Uniswap or Curve, you've already seen liquidity in action. But providing it, that's where the real earning potential lies, if you know how to manage the risks. Before we go deeper, a quick reminder. Crypto assets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. Let's start by answering the core question, what is liquidity providing? In simple terms, decentralized exchanges like Uniswap or PancakeSwap don't rely on order books like traditional exchanges. Instead, they use liquidity pools, which are smart contracts filled with pairs of tokens. When you provide those tokens, like ETH and USDC, you're helping the market function. Traders pay a fee for each swap, and as a liquidity provider, you earn a portion of those fees. Think of it like renting out your crypto to the exchange and getting paid every time someone uses it. But why would anyone do this instead of just holding their coins? The answer lies in yield, real, tangible returns paid out from trading activity. For example, if a liquidity pool has $10 million and it generates $1 million in trading fees over a month, those earnings are distributed proportionally to all liquidity providers in the pool. The more liquidity you provide, the more you earn. This system is designed to reward participation without needing a centralized middleman. Liquidity providing became famous during the DeFi summer of 2020, when yield farming exploded. At the time, platforms like SushiSwap and Balancer were offering massive rewards in their native tokens just for providing liquidity. But over time, the focus shifted. Instead of chasing unsustainable token emissions, many investors started looking for real yield, fees generated from actual protocol usage. That's what modern LP strategies are all about. Now, to provide liquidity, you typically deposit two tokens in equal value. For example, on Uniswap, if you want to join the ETH USDC pool, you deposit $500 worth of ETH and $500 worth of USDC. These tokens sit in a smart contract, where they help facilitate trades. In return, you receive LP tokens, receipts that represent your share of the pool. When you're ready to withdraw, you burn the LP tokens and get your assets back, plus any fees you earned while they were active. But here's where things get tricky, impermanent loss. This is one of the biggest risks in liquidity providing, and it happens when the value of one token changes significantly compared to the other. Let's say ETH doubles in price while USDC stays stable. The automated market maker will rebalance your pool to keep a 50-50 ratio, meaning you'll end up with less ETH than you started with. This loss isn't permanent unless you withdraw at that point, hence the name, but it can still eat into your profits if you're not careful. So how do you mitigate impermanent loss? There are a few strategies. First, provide liquidity to stable coin pairs, like USDC, DAI. Since both assets are pegged to the dollar, there's minimal volatility between them. Second, look for concentrated liquidity models like Uniswap v3, where you can set custom price ranges. This allows you to control your exposure and maximize fees in specific zones. It's more advanced, but far more efficient if you know what you're doing. Another option is to provide liquidity in single-sided vaults or through platforms like Curve, which are optimized for low slippage and stable assets. Curve's pools, for instance, are designed to minimize impermanent loss while still generating yield. That's why they're so popular with large-scale DeFi users. There are also automated vaults that handle LP strategies for you. Protocols like DeFi Finance or Yearn Finance take user deposits and allocate them across high-performing liquidity pools. They auto-compound rewards and rebalance positions to minimize risk. It's a good way for beginners to get exposure without managing every detail themselves. But keep in mind, these platforms also take a cut of the profits, usually 5 to 20%. You'll also want to watch gas fees. Every time you enter or exit a pool, especially on Ethereum mainnet, you pay transaction fees. That's why many users are shifting to layer 2s like Arbitrum, Optimism, or even other chains like Avalanche, BNB Chain, or Polygon. They offer the same DeFi tools with faster speeds and dramatically lower costs. Let's talk about the rewards. A good liquidity pool can earn anywhere from 3% to 50% April, depending on the trading volume, fee structure, and protocol incentives. Some pools also reward you with extra tokens, like governance coins, which can be claimed or staked for more yield. But always do your homework. If the returns seem too good to be true, they often are. Speaking of risks, aside from impermanent loss, you also have smart contract risk. Since liquidity pools run on code, bugs or exploits can lead to loss of funds. While top platforms like Uniswap and Curve are heavily audited, smaller protocols may not be. Always check if a protocol has a strong track record, insurance options, or third-party audits. Then there's project risk. If the tokens you deposit lose value, even without impermanent loss, you could still end up with less than you started. That's why it's important to evaluate the health and utility of each asset in the pool. Stick to blue-chip pairs unless you're experienced and willing to take more risk. So, how do you get started? First, choose a DEX like Uniswap, SushiSwap, or Curve. Then connect your wallet. MetaMask is a common choice. Choose a pool you believe in and deposit equal values of both tokens. Confirm the transaction, and you're in. From that point forward, you'll earn a cut of every trade made in the pool. For more automation, you can use apps like Zapper, DeFi Saver, or Beefy to monitor and manage your positions. These dashboards show your real-time earnings, risk exposure, and help you rebalance if needed. Some even let you swap between pools without withdrawing and redepositing. Timing also matters. Liquidity tends to spike during bull markets when trading volume is high. That's when LP fees are most profitable. During bear markets, volume drops, and fees shrink, but so do the risks of impermanent loss. You can use this cycle to your advantage by adjusting strategies seasonally. There's also a growing trend of real yield LPs. Projects like GMX or Ethena pay out actual protocol revenue, not inflationary rewards. These platforms use liquidity providers to enable leverage trading or synthetic assets, and distribute the earnings accordingly. It's a model that's more sustainable long-term, and many believe it's the future of DeFi income. Ultimately, liquidity providing is one of the most powerful tools in crypto, but it's not for everyone. If you're just getting started, try small amounts first. Focus on stable pairs. Use tools to track your performance. And never deposit more than you're willing to lose. Like any strategy, LPing requires knowledge, patience, and risk management. To wrap it up, by providing liquidity, you're not just betting on price. You're earning from usage. Every trade, every swap, every arbitrage, you get a slice. That's how exchanges make billions. And now, thanks to DeFi, you can too. But do it wisely. If you found this helpful, don't forget to like, subscribe, and check out the next videos in our Crypto Pulse passive income series. Your journey to smarter crypto investing starts right here.